Imagine paying your homeowner's insurance faithfully for 15 years, never filing a single claim, and then opening a letter that simply says your policy is being cancelled, not because of anything you did, but because your insurance company has decided your entire state is too risky to operate anymore. This is not a hypothetical. This has already happened to hundreds of thousands of American homeowners in the last 2 years, and it is accelerating right now, in real time, in some of the most populated states in the country. Let's start with the headline numbers, because they are genuinely staggering. In 2023, State Farm, the largest homeowners insurance provider in the United States, announced it would stop accepting new home insurance applications in California entirely. A few months later, Allstate did the same thing. In 2024, State Farm went further, announcing it would not renew tens of thousands of existing policies across the state. This is not a story about one struggling company. These are the largest, most financially stable insurers in the country, voluntarily walking away from one of the biggest insurance markets in America. Florida has it even worse, and has for longer. Since 2022, over a dozen insurance companies operating in Florida have either gone completely insolvent or voluntarily withdrawn from the state entirely. Homeowners who did not lose coverage outright have watched premiums spike by 40, 60, sometimes over 100% in a single renewal cycle. Louisiana, another major hurricane-exposed state, has seen a nearly identical pattern play out over the same period. So what is actually happening here? And why now, specifically, after decades of these companies operating profitably in these exact same states? The core answer is that the actual mathematical models insurance companies use to price risk have fundamentally broken, and they broke because the physical world stopped matching the historical data those models were built on. Insurance pricing works by looking at decades of past claims data to predict future risk, then setting premiums high enough to cover expected future payouts while still making a profit. That entire system depends on the future looking statistically similar to the past. In wildfire and hurricane-prone states specifically, the past several years have stopped looking anything like the decades of historical data the models were trained on. California wildfire losses provide the clearest example. The 2017 and 2018 wildfire seasons alone generated more insured losses in the state than the entire previous decade combined. The 2018 Camp Fire, which destroyed the town of Paradise, California, generated roughly $10 billion in insured losses from a single event. Insurers who had spent decades pricing wildfire risk based on historical frequency and severity found their models catastrophically wrong in the span of just a few fire seasons, and adjusting pricing to match the new reality would require premium increases so large that California's own insurance regulations, which require state approval for major rate hikes, would not allow companies to charge what their updated models said was actually necessary. Rather than operate at a loss indefinitely while waiting for slow regulatory approval, several major insurers simply chose to stop writing new policies in the state entirely. Florida's situation involves a similar climate risk problem layered on top of a second, entirely different issue: rampant insurance fraud and litigation abuse that has nothing to do with weather at all. Florida accounted for a genuinely stunning statistic for years. Despite having less than 10% of the homeowners' insurance claims filed nationally, the state was responsible for roughly 80% of homeowners' insurance lawsuits filed nationally, according to data cited repeatedly by Florida's own insurance regulators. A significant driver of this was a legal practice involving contractors who would get homeowners to sign over their insurance claim rights, then dramatically inflate repair estimates and sue insurers directly when the inflated claims were disputed, generating attorney fees that state law required insurers to pay, regardless of whether they won or lost the underlying case. Florida passed significant tort reform in 2022 and 2023, specifically targeting this practice. And there are early signs the market may be stabilizing slightly as a result, though premiums remain dramatically higher than they were even 5 years ago. Now here is the part of this story that connects directly to something almost nobody thinks about until it happens to them. What occurs when your private insurer cancels you and you cannot find a replacement on the regular market at any price? Every state has what is called a fair plan, or an equivalent state-backed insurer of last resort, originally designed as a small temporary safety net for homeowners who genuinely could not get coverage anywhere else. California's Fair Plan, which was built to be a minor backup option, has seen its policy count more than double in just the past few years as private insurers pulled back, and it now insures well over 400 properties statewide. This creates a serious structural risk that insurance regulators have openly acknowledged. Fair plans typically offer more limited coverage than standard policies, often excluding things like liability coverage or personal property protection that homeowners assume are included. And critically, these state-backed plans were never designed or funded to handle the sheer volume of policies now being forced onto them. If a major wildfire or hurricane were to hit an area concentrated with fair plan policies, some regulators have warned the plan itself could face solvency problems, potentially requiring a special assessment charged to every insurance policyholder in the state, not just those on the fair plan, to cover the shortfall. This is where the story stops being just about people who happen to live in wildfire or hurricane zones and starts becoming relevant to homeowners and renters everywhere, because insurance markets are increasingly interconnected across state lines. Reinsurance, essentially insurance, that insurance companies themselves buy to protect against catastrophic losses, has gotten dramatically more expensive globally in the past few years as climate-related disasters have increased in frequency across multiple regions simultaneously. That rising reinsurance costs gets passed down into homeowner premiums everywhere, not just in the states making headlines, which is part of why homeowners' insurance costs have been climbing nationally, not just in California and Florida specifically, even in states that have not experienced any unusual disaster activity themselves. So what does this actually mean for you practically, whether you currently own a home in a high-risk state or are watching this unfold from somewhere that feels safer for now? If you own a home in California, Florida, Louisiana, or increasingly other states facing similar climate exposure, checking your policy renewal terms carefully, rather than assuming automatic renewal has become a genuinely necessary habit, because non-renewal notices are increasingly common and can arrive with relatively short windows to secure replacement coverage. Understanding whether your specific policy would actually cover a full rebuild at current construction costs matters more than it used to, because a policy purchased years ago at a lower coverage limit may not reflect how dramatically rebuilding costs have also increased. And if you are house hunting anywhere, checking current insurance availability and typical premium costs for that specific area before finalizing a purchase has become as practically important as checking the school district, because a home that appears affordable based purely on its price and mortgage payment can become financially unmanageable if insurance costs alone climb into the thousands of dollars monthly in a shrinking market. The uncomfortable pattern underneath all of this is that homeowners insurance was built on the assumption that the future would resemble the past closely enough to price risk accurately. In a growing number of American states, that assumption has quietly stopped holding, and the companies whose entire business model depends on getting that math right are responding by simply leaving, one state at a time, while state-backed safety nets that were never designed for this scale absorb the difference with genuinely unresolved questions about what happens if they are tested by a truly catastrophic year.